Hi, I'm Jamie Small with Ottawa Mortgage Advisors, and today I'm going to talk about some of the recent changes that CMHC has made that came into effect in April of 2010. One of the big changes that CMHC made is that they've now set a benchmark interest rate for any borrowers who are taking a fixed rate term of less than 5 years or any variable rate term. So prior to these changes that CMHC has made, any borrower simply had to qualify at whatever the contract interest rate was on their mortgage. So essentially whatever your interest rate was on the mortgage, that was the interest rate that was used for qualifying. Now that CMHC has implemented this benchmark interest rate, which is significantly higher than where interest rates are at right now, essentially what it does is it makes it more difficult for borrowers to qualify for shorter term fixed interest rates and for variable interest rates. One of the reasons that CMHC implemented this rule is that with interest rates as low as they've been over the last year or year and a half, CMHC felt that borrowers were over leveraging themselves. So to prevent people from borrowing more than what CMHC felt they could afford in the future when interest rates increase, they've implemented this benchmark interest rate to try and protect consumers from borrowing too much money and running into financial difficulty in the future when interest rates do rise. So some pretty significant changes from CMHC makes it a little bit more difficult for consumers to qualify for these types of products. But overall, a good change, and it's going to set up our economy for being a much better situation in the future.